Hi there, my name is Michael Wright and I am the Head of Product for Tax at the Access Group APAC. The 2024 year has begun for tax time and accounting practices around Australia. And we want accountants to feel as prepared for the upcoming compliance changes as possible. In this video, we'll give you an overview of 4 key changes from the ATO for 2024. That way your practice is ready for the upcoming tax time. So now let's start with one of the measures, temporary full expensing. And that is coming to an end. It was introduced to help businesses recover from the economic impact of COVID-19 and was always intended to be a temporary measure. The temporary full expensing provisions ended on the 30th of June 2023, which means expenses incurred on and from the 1st of July 2023 will not qualify for temporary full expensing. Therefore, all of the 2024 returns that you see will have temporary full expensing labels removed. The forms that are impacted are going to be the company return, the partnership return, the trust return, the individual, the AMIT, and the CCVIV. And the ATO website has a great wealth of information about this measure. Simply Google TFE space ATO, and you will see the choice right there in front of you. Another COVID measure, the loss carryback, is also being removed from the 2024 returns. All the labels that you had seen in the previous company tax return for the loss carryback will be removed for the 2024 version of the company tax return. Tax losses will only be able to be carried forward from the 23-24 income year onwards. And for corporate tax entities who are required to complete a losses schedule or a consolidated group losses schedule, they will no longer need to deduct the losses carried back from their losses carried forward from the 23-24 income year onwards. Again, the ATO website has a great wealth of information about this measure. Simply Google loss carryback and you will see the choice right there. Now let's switch gears and discuss a topic you may not be aware that is coming. The Modernisation of Trust Administration Systems project was announced in the March 2022 budget as the Digitalising Trust Income Reporting and Processing measure. This is an ATO-wide strategy which aims to improve the quality, accuracy and integrity of income information reported by trustees and beneficiaries. The ATO state that the project aims to deliver improvements to 3 areas. 1 being the lodgement experience for trustees and beneficiaries and providing greater support to meet their reporting obligations. The administration and processing of trust reporting obligations. And lastly, the ATO's data-driven decision-making processes, including those which inform compliance and assurance activities. So, a trust income schedule will now be lodged as part of the tax return lodgement process for all beneficiary types. Known as the TIS, it will replicate most of the income labels from the trust statement of distribution and will require information identifying the distributing trust. The tax returns of each beneficiary type will not change. Rather, the schedule will complement the tax return. What does all this mean? Think about how values are distributed from a trust distribution. These amounts will now appear in the other forms that receive these amounts, with the trust amounts now mirroring the distribution like it was in the trust. It is basically data matching the amounts from the trust to the same amounts in the beneficiary returns. To do this, there will be additional labels that all software companies will be building in the 2024 year in the beneficiary returns. These are 4 new labels for capital gains at the beneficiary distribution section, and they cover gross capital gains, capital losses applied, CGT discounts applied, and CGT small business discount applied. The forms impacted for 2024 will be these returns requiring a trust income schedule to be attached. And they cover forms like the individual, the company, the trust, the partnership, funds, and the self-managed super fund. And lastly, now let's discuss a topic that the ATO wanted to implement last year, but pulled it out at the last moment. Enhanced pre-fill for welfare amounts. You may remember a few years ago, the ATO changed how pre-fill for interest at item 10 was conducted. They have a high degree of confidence that the value is correct, and they are effectively locking that amount after you pre-fill it. And if you want to change it, you have to provide a reason. These appeared as the pre-fill certainty indicator and the adjustment code reason. Now, the same is happening at item 6 at Australian Government pensions and allowances. When pre-fill contains a value for pensions and allowances at item 6, the pre-fill certainty indicator and the adjustment reason code will apply just like it does today at item 10. Any amounts you see are not easily changeable, and if you do need to adjust the amount, you need to choose an adjustment reason code. So if you're looking for more information to get you ready for tax time, follow the link in the description below to our Tax Time Hub. You'll have access to a wealth of resources and guides to help you prepare for this year's tax season. Thank you.